Hi, I'm Bill Tierney with McClellan Real Estate here in Cohasset, Mass. And today we are lucky to be talking with one of my favorite loan officers, and a very accomplished one at that, Kathleen Caudell with Fairway Mortgage.
Thank you, Bill. It's a pleasure to be here.
Always fun to do things with you. Anyway, Kathleen, I wanted to just have a quick dialogue with you and talk about sort of what we're seeing is, almost some people call it a freeze up in the real estate market, where people are really just not apt to move because they've got that high two low three interest rate, and they're not looking to move. And so, like, if you're just like in my market, I do business with a lot of downsizers, as they call them. You have that big 4-bedroom home and nobody's home, and you're paying to heat it and taxes and maintenance, but it's kind of hard to give that up with the higher interest rates. And so I know you had a couple ideas to, as some solutions to that, or different ways to look at it. So why don't I open the floor to you on that, and we can talk about, sort of what to do in this new interest rate environment.
Sure. So right off the top of my head, I have an idea of, instead of worrying about getting a new mortgage rate in the 7s or the 8s as they've been over the last couple of months, how about a no payment mortgage? So this is pretty fantastic for anybody that's 62 years of age and older. That will help them to right size. And I say right size, Bill, because sometimes it's going to a smaller home, but sometimes it could be going to even a larger home because you are looking for the first floor primary, and getting upstairs might be an issue. Or you want to actually be closer to a golf course or the ocean or your grandkids. So I call it right sizing. So this mortgage is called a HECM, because we do love our acronyms in the mortgage world.
What the heck is that?
It is a home equity conversion mortgage. So I would suggest to somebody that might even be an all cash buyer, instead of using all of your cash for this, maybe put down 50, 60, or 70% instead, and give the rest to your financial planner, or just put it in another vehicle that you want to use. Maybe it's your fund or vacation fund, or maybe it's going to buy you long-term care or life insurance, or just put it in the bank. It's yours to do with as you please, but let's take the rest and finance it with this HECM. It must be on your primary residence. You must continue to pay your real estate taxes, your homeowners insurance, and if you have any HOA dues, but you will not have a mortgage payment for the rest of your life, actually until 150 years of age. And we put that in writing, Bill, and if you live longer, we'll extend it.
I'd like to make it 100. 150 be fine.
Right. So this is pretty great because it does free up that cash. It does take away that stress of, I'm not sure I'm going to be able to afford this new home, or my dream would be to live on that ocean property in Situate or Cohasset, but I can't afford it. Maybe you can with this type of a loan, because you're not going to have a payment. And it is insured. It is an FHA, government insured loan. So that insurance is going to be a non-recourse loan. So no matter what happens to values, we cannot take this loan away. You can make a payment if you so desire. Payments are optional, but you do not have to, as long as you maintain it as your primary residence, keep paying your taxes and insurance.
So talk to me, husband and wife buy the house tomorrow, and a week from then, the husband passes away. How does that impact the wife who's still living in the house, the primary residence?
I'm so glad you brought that up, Bill, because it has zero impact. So the remaining spouse can live there to the rest of their life. Absolutely no change. Nothing changes on this product. Whereas that could be a major life change for that same couple. If in the house that they're in right now, maybe 50% of their income goes away and they can no longer even stay in that property. I see that all the time. I just was at an open house in Pine Hills, actually, last weekend, and the seller was in that exact situation. They had no choice, but they had to sell because one spouse had passed away. With this type of loan, you take that fear away and you can age in place and stay right in that home for the rest of your life.
I mean, that sounds like a solution for a lot of people. And financially, when I've brought this up with people, there's been a little bit of a pause of, well, I want to leave my kids with something. But since you're limited as to how much you can use with the HECM, um, doesn't this sound like it makes more sense financially for some people?
Yes, and actually, Bill, I'm so glad you brought that up because many people think, well, then I'm leaving nothing to my kids. And that's not necessarily true. This is not designed to be upside down, which is why we need to have equity in this property when you purchase it. You can't do 100% financing. You need to put down at least 50%. Depending upon how young you are, you might need to put down more, maybe 60 or 70% when you do it for a purchase. Many people think, Bill, that this is a loan that's only used for refinance, but I'm here to tell you we do them for purchases regularly and actually as little as 17 days from start to finish. So they're quick. But this isn't designed to be upside down where you owe more than what the property is worth. And potentially you have somebody who has taken the rest of their cash and invested it and used it with their financial planner, and you could potentially leave more money to your heirs. Let me give you an example. Let's talk about a couple that has $500,000 in their equity of their home, and they have $500,000 in their financial planner's tool, or toolbox, as I call it. And they die, one spouse passes away, and then the other one needs in-home care, but doesn't need assisted living, wants to stay where they are, which right now bills $500 a day or more minimum. And they're quickly dwindling that $500,000 that they have with their financial planner, and they spend that all down. And they get sick and they have to go to that nursing home, and the nursing home takes that home. They've left nothing to their children. Let me give you an alternative. They take this out on their property and they live off of the equity of their home and leave that $500,000 with their financial planner. They can maybe have the cash from living in that home with living off that equity to age in place and stay there the rest of their life and not maybe have to go to assisted living or to a nursing home. Even if when they passed away, there was no equity left in that home, there's more money potentially that the financial planner has allowed to grow with them. So potentially you could leave even more money to your children.
Yeah, I mean, you'll have the equity in the house, which over time should appreciate, the equity in the capital markets, and the savings of not having a payment. This sounds like a home run for some people. How would people find you?
So they can call me directly anytime at 617-780-9297. I'm with Fairway Independent Mortgage, and my email address is kcaddell, which is my name, K and then Kathleen, K for Kathleen, and then Caddell is CADDELL at fairwaymc.com.
Oh, cool. You know what I'll do is also below in the comment section, I'll put your contact info so if people need it, they can find it.
Perfect.
This has been awesome. It's very helpful as to, a reverse or what they call a home equity conversion mortgage. And I appreciate your coming on, and maybe next week we can go through a couple of future uses.
I look forward to it. Thank you, Bill.